So financial reporting. We started BPP kit questions on consolidation. So let's work on question 254. What's the answer? Option A.
Yeah.
Cloud company obtained a 60% holding in the $100,000 one share of missed company on 1st January 20x8. Cloud company paid 250 cash immediately with an additional 400,000 payable on 1st January 20x9. After how many years? How many years? 1 year. Okay. And one share in cloud company for each 2 shares acquired. Cloud company has a cost of capital of 8% and the market value of its share on 1st January was 230. What was the total consideration paid? So cash. They have paid how much? 250,000. So contingent consideration, that is how much? 400,000 into 1 divided by 1.08. What's the value? 370. 370. And share. How many shares?
60,000 shares.
60,000 shares, 100,000 total, 60% they acquired. So 60,000 shares and they are giving how many against what? 1/2 and we will multiply with market value that is 2.30. What's the value? 69,000 altogether. Altogether 689,370 and option A. Okay, 255, please. Good luck out. Sorry?
Why are there 2 boxes?
I don't know. Might be one for amount, dollar, and one for whether increase, decrease, add, subtract. Effect: will any adjustment required in respect of the property have on group retained earning at 30th September 20x1? Year end is 30th September 20x1, and you need to provide what effect this adjustment will be having on group retained earning, whether we need to increase retained earning, we need to decrease group retained earning due to this effect. On 1st June 20x1, what's the year end? 30th September 20. 4 months. June, July, August, September. Okay. On 1st June 20x1, Premier Company acquired 80% of the equity share capital of Sanford Company. At the date of acquisition, the fair value of Sanford Company's net assets were equal to their carrying amount, with the exception of its property. And if there is difference between fair value, we need to adjust. This had a fair value of 1.2 million below its carrying amount. This had a fair value of 1.2 million below its carrying amount. In carrying amount is more. If carrying amount is more, this means they charge more depreciation. They charge more depreciation because depreciation is calculated on carrying amount. If it is not adjusted to fair value, the asset was still on carrying amount. This means the depreciation charged on asset was more. Excess depreciation charged. So that we need to adjust with consolidated retained earning, whether they should be added or subtracted. If excess depreciation is charged, we need to calculate that excess depreciation and we need to add with retained earning, mean through that retained earning should be increased. The property had a remaining, this had a fair value of 1.2 million below its carrying amount. The property had a remaining useful life of 8 years. So by how much the carrying value was more? 1.2 million. And its remaining useful life is what? 8 years. So what is the per year depreciation? 150,000. When you acquired? 1st June. This means 4-month depreciation was charged.
Yeah, 50.
What is 4 by 12? 50,000. What adjustment is required? How much you have acquired? 80%. So with 80% adjustment is required in retained earning. How much? So with the 40,000, you need to increase retained earning or decrease retained earning. Ready. Is that?
The evaluation will go where the profit comes.
We are talking about depreciation.
Yeah, no, but like reduce the value of the property.
Revaluation will go into other comprehensive income.
But it will be negative. Wouldn't be negative.
No, at the time of acquisition, we should record assets, liabilities or subsidiary at fair value.
Yes.
But if some of the asset or liability was not recorded on fair value, then you need to make adjustment at year end.
So over here, fair value.
Here it was a case, one property whose fair value at the time of acquisition was different, carrying value was different. Mean you didn't record it on fair value. because for other assets, as the fair value, carrying value was the same, so you didn't adjusted any of the asset. But afterward, you found that there was a mistake. One property whose fair value was lesser than carrying amount. I mean, it was remain on carrying amount till end. So at year end, we are making adjustment. It's not about revaluation. Revaluation is a policy of company. Company can record asset either on cost basis or revaluation basis. Revaluation basis mean at every year end, you need to compare carrying value with market value. This is consolidation, mean at the time of acquisition, you need to measure fair value of net assets acquired. But if some of the assets, some of the liabilities was not recorded or measured at fair value, so afterward you need to make adjustment.
So where is the difference?
It says all the assets carrying value and fair value was the same, except one property, one asset, whose fair value was 1.2 million lower than carrying amount. Mean you recorded that asset on carrying value throughout the year. You charge depreciation based on the carrying value that was more than fair value. In fact, it should have been adjusted to fair value, but that was not done at that time. If it was adjusted at that time, then there was no issue. But at year end, you are aware this was a mistake at the time of acquisition. Due to that, depreciation was calculated on higher amount.
So on year end, you're rectifying.
Yeah, we are.
So where does difference go? Does it go to OCI? Does it go to PNL?
With retained earning, he's asking about group's retained earning.
That's
Depreciation, where we record the depreciation.
that's what that I'm asking. Over here, they didn't ask, but where would it go? The 1.2 million, the difference. You're adjusting.
This means we need to reduce the asset as well. But for that, we need some other information as well. What was the carrying value? What was the depreciation? When it was bought? How much was cost? 256, please. Consideration paid, you need to calculate. Examiner can make complete question by adjusting this kind of adjustment. What is the amount of the consideration attributable to Pectonic Company for the acquisition of Sardonic Company? Mean consideration paid, you need to identify. On 1st August 2007, Pectonic Company purchased 18 million of 24 million equity shares of Sardonic Company. 18 million of 24 into 100, how much is that? 75%. The acquisition was through a share exchange of 2 shares in Petronic Company for every 3 shares in Sardonic Company. So first share 18 million you are taking, and 2 by 3. 1.2. Or whatever is the value, we will multiply with market value. Yeah. The market price of share in Petronic Company at 1st August 20x7 was 5.75. What's the value? 6.9. Okay. Petronic Company will also pay in cash on 31st July 20x9. When it will come? 20x7, 20x8, 20x9. After 2 years. 2 years after acquisition. 2.42 per acquired share of Sardonic Company. Contingent consideration not given in amount. 2.42 per acquired share of Sardonic Company. How many shares we are acquiring? 18 million into 2.42. This will provide you the amount that you need to discount. What is that amount? 43 million, 43 million, 560. 560 million. For 2 years, and the cost of capital is 10%. So multiply by 1 divided by 1.10 raised to power 2. What's that value? 36. 36? 36 million. 36 million altogether. Okay. 36 million. That is the 6.9 million or 69 million. So 69 plus 36, that is 105 million. This was a bit difficult regarding contingent consideration. Because normally in contingent consideration, we were having amount that we can calculate present value. But here amount is given, but in terms of share price. 257, please. Yeah, from these 3 options, you need to see what should be a debit, what should be credit. So using the drop-down option below, demonstrate how Picard company would account for this 1.5 million adjustment in the financial statement as at 31st March 20x1. On 1st April 20x0 at start of the year, Picard company acquired 75% of Sander company's equity share by means of a share exchange and an additional amount payable on 1st April 20x1 that was contingent upon post-acquisition performance of Sander company. At the date of acquisition, Picard company assessed the fair value of this contingent consideration at 4.2 million. But by 31st March 20x1, it was clear that the amount to be paid would be only 2.7 million. Mean they calculated this amount, 4.2 contingent consideration, but they realized the correct amount was this. There was 1.5 million difference. How it should be adjusted. Contingent consideration. Where we record it? Where we record contingent consideration? PV of contingent consideration we record as a liability. This means liability was more recorded by 1.5 million. So you need to debit what current liabilities. What should we credit? Retained earnings. Is that 258, please? Was the goodwill arising on the acquisition? I mean, you need to calculate goodwill of bank company if the NCI is measured at a fair value method and proportionate of net assets method. You need to calculate two goodwill amounts using fair value method, using proportionate of net asset method. This means by net assets. How we can calculate net assets? Total assets minus current liabilities or equity plus long-term non-current liabilities. Till now, we were calculating using equity plus non-current liabilities. Crash company acquired 80% of bank company's $100,000 one ordinary shares, means share capital is 100,000 of the subsidiary. For 800,000, this mean you paid how much? 800,000. When the retained earning of bank company was 570. So share capital is 100,000 and retained earning 570 at the time of acquisition. Bank company also has an internally developed customer list, which has been independently valued at 90,000. They are having some internally developed customer list, means this is also their asset. This means fair value of net assets is what? 100 plus 570 plus 90. How much is that total? 760. Now we need what? Fair value of non-controlling interest. The directors of crash company are deciding whether to recognize a non-controlling interest at fair value or at its share of the net assets of bank company at the date of acquisition. The fair value of non-controlling interest in bank company was just to be 220. If the fair value of non-controlling is 220, so through fair value we can calculate goodwill. How much? 260. This will remain same. Only this will change based on proportionate. If we see on proportionate basis, so 760 is the amount of net assets and non-controlling interest is 20%. So what is 760 20%? 150. So what is goodwill now? This will be 260,000. This will be 192,000. When you click on it, it will provide you all four options. Is that? 59, please. How should the purchase of L be reflected in a T company's consolidated statement of financial position? In what is the accounting statement? T acquiring L. As a company, a parent company acquired Loudon Company, an unincorporated entity for 2.8 million. This is consideration paid. A fair value exercise performed on the company's net asset at the date of purchase showed property, plant, and equipment, identifiable intangible assets, inventories, trade receivables, less trade payables. Mean this is a fair value of net assets acquired. So consideration paid is 2.8 million, while fair value of assets is 4 million. What is goodwill? Negative goodwill, sir. What could be the accounting treatment? Record the net assets at the carrying amount shown above and credit profit or loss with 1.2 million. Record the net assets at the carrying amount shown above and credit T company's consolidated goodwill with 1.2 million. If there is a negative goodwill, we shouldn't record it. D, recognize the identifiable intangible asset. Why? Record the remaining net assets at the carrying amount shown above and credit profit or loss with 700,000. Bullshit, you are saying. Record the purchase as a financial asset investment of 2.8 million. Record all the net assets at carrying amount and charge this negative goodwill to equity retained earning mean profit or loss. This other seems stupid. Is that purchase bargain? It's not goodwill. Is purchase bargain. 260. Is the total charge to the group's retained earning. How much you need to adjust with group retained asset. Pratt Company acquired two subsidiaries in the year ended 31st December 20x5, and Pratt Company values non-controlling interest at fair value. What does that mean? Impairment will be included in retained earning calculation and non-controlling interest calculation. On 1st January 20x5, year end is 31st December 20x5, and they acquired two subsidiaries. On 1st January 20x5, Pratt Company acquired 80% of the equity shares of Sam Company. Goodwill at the date of acquisition was correctly calculated as 20,000. The goodwill of Sam Company was not impaired in the year ended 31st December 20x5. It is not impaired. Do we need to include anything with the retained earning relating to goodwill? No. In reviewing the fair value of Sam Company's net assets at acquisition, Pratt Company concluded that property, plant, and equipment with the remaining life of 5 years had a fair value of 5,000 in excess of its carrying amount. Property, plant, and equipment with the remaining life of 5 years had a fair value of 5,000 in excess of its carrying amount. This means carrying amount was lower by 5,000. This means they calculated depreciation lesser. We need to calculate how much depreciation we need to record more. Same previous question 1.2 million where there was charged more, but we calculated how much it should be reduced. But here we need to calculate how much depreciation should be charged more. So by how much? If we see about Sam Company. So 5,000 is the amount difference. How much is the remaining useful life? 5 years. So per year depreciation is what? 1,000. What is your share? With 800, you need to adjust the consolidated retained earning. Either you need to reduce or increase retained earning. Reduced consolidated retained earning. Because this depreciation was charged less. So we need to charge more. How? We need to charge to profit retained earning. So through this, retained earning will be reduced because charging more depreciation means this depreciation is more required. Yeah. Is that? So what was the issue? Depreciation need to charge more. Comment? On 1st April 20x5, Pratt Company acquired 75% of equity shares of a trade company. Other subsidiary. Goodwill at the date of acquisition was correctly calculated 50,000. At 31st December 2005, the goodwill in a trade company was impaired by 40%. In there is impairment of goodwill. How much? 50,000 is the amount of goodwill. 40% is impairment. How much is total impairment? How much? 20,000. Out of this, how much should be charged to retain earning? 75% remaining should be charged to non-controlling interest calculation. How much is 75%? Sorry? 15,000? How much is altogether? They asked about how much should be adjustment with the consolidated retained earning. So one issue was impairment because company recording non-controlling interest on fair value basis. In case of proportionate method, don't need to charge impairment to retained earning or non-controlling interest. Shall we move forward? Was there any issue in the first part? We need to record assets liabilities at acquisition on fair value. But one of the assets whose fair value was different, carrying value was different, mean they forget to record on fair value. Mean their fair value was more. Mean there was a difference of 5,000. Mean carrying value was 5,000 lesser. This means you charge less depreciation. So we need to calculate how much depreciation we need to charge more. Where it will be charged at year end because everything is going to where consolidated retained earning. Relating to P&L, everything is going where consolidated retained earning. Even subsidiary profit share is going there. Parent company profit going there. To 61. Last adjustment of question we covered. That's to understanding 7. Unrealized profit. That should be eliminated. Relating to unsold inventory at the end. That company has owned 60% of the equity share capital of SAPI company for many years. At 31st October 2007, the individual statement of a financial position include the following. Current assets for both the companies, current liabilities for both the companies. So these should be added, but we need to see, is there any adjustment that we need to make? What they are asking in respect of the current asset and current liabilities, what amount will be reported in consolidated statement of financial position? I mean, you need to calculate current assets, current liabilities, total figure. Okay. Neither had a bank overdraft at 31st October 2007. During the year ended 31st October 2007, Flat Company, parent company, made 100,000 sale on credit to subsidiary company, and subsidiary company had 1/4 of these goods in inventory at 31st October 2007, mean remaining sold. That company make a 20% gross profit margin on all sales. How much is the sale amount? 100,000. And they charge 20% profit on sale. That is what? 20,000 is a total profit. Out of this, 1/4 of these goods are still in inventory at year end. What is quarter? 1/4? Into 1/4, that is a 5,000 is a unrealized profit. That is where it is included. It is in the inventory. In the inventory. So that we need to eliminate from inventory. Okay. On 31st October 2007, subsidiary company sent a check for 50,000 to pay all of the outstanding balance due to Flat Company. All the balance. Flat Company didn't receive this check until 22nd of November. Cash in transit. What was the accounting entry? Debit, cash, credit, receivable. Because they were having 50,000 receivable payables. In parent, there was 50,000 receivable, and subsidiary, there was 50,000 payable. Subsidiary paid the cash, they eliminated payables. But the cash is not arrived at parent company, they are still having a receivable. So what is the effect of this entry? 50,000 will be reduced from receivable, and 50,000 will be recorded as cash in current assets. We having a nil effect for this. What will be the current asset then? 700 plus 500, 1,200 minus 5,000. 1.195 million. And current liability will remain same. 0.5 million. What's the option? Come on. Oh, yeah, sorry, D. Is that?
Yes.
The same, we covered this question. all of the outstanding balance due. Meaning there is no other receivables payables except these 56. 262. Don't look at the requirement. Just see what accounting entry we need to pass. What is the journal entry required to reflect this fair value adjustment in the consolidated statement of financial position of both company at 31st December 20x6? Both company acquired 60% of Anchor Company on 1st January 20x4. At start of the year? No, 2 years back. Or 3 years back. 20x4, 20x5, 20x6. 3 years back. At the date of acquisition, the carrying amount of subsidiaries net assets were the same as their fair value, with the exception of an item of machinery which had a carrying amount of 90,000, a fair value of 160,000, and a remaining useful life of 5 years. Non-controlling interests are valued at fair value. What was the difference? 14. Carrying amount 90,000, fair value 160,000. So there is difference of 70,000. When with the 70,000, net assets was recorded lesser. With 70,000, net assets were recorded lesser. This means with 70,000, we need to increase the asset. Yes. We are net assets involved in another calculation, another figure calculation. Net assets are involved in goodwill calculation as well. This one, if net assets was recorded lesser, goodwill was recorded more. We need to adjust goodwill as well. Mm. So for the 70,000, we need to make one accounting entry: debit property, plant and equipment 70,000, and credit goodwill 70,000. Is that? This means if asset was recorded lesser by 70,000, the depreciation was also recorded lesser by 70,000.
Yes, the difference is 14.
And we need to record that depreciation adjustment as well. 70,000 was the difference. Remaining useful life is what? 5 years. What is per year depreciation? 14,000. But for how many years? 3 years. Multiply by 3. That will become 42,000. With this 42,000, what we need to do? We need to reduce the asset. We need to reduce the asset. Is that? We need to reduce the asset. And we need to reduce what else? Retained earnings. But with how much? Your percentage. How much is your percentage? 60%. Your percentage is 60%. Mean we need to record accounting entry, credit, property, plant, and equipment with the 42,000. And we need to debit what? Consolidated retained earnings, but with 60%. Is 60% of 42,000? 25,200 remaining NCI.
16,800.
16,800. This is 60% and this is 40% of 42,000. Now, if we combine this entry, property, plant and equipment 70,000 debit, 42,000 credit, so will become a debit. Debit, property, plant and equipment with 28,000. Debit, consolidated retained earnings with 25,200. Debit, non-controlling interest with 16,800. On credit with this adjustment we need to make. See what's the option is there. There are 4 options. Can you understand this?
Yes.
Let's move forward to 63, please. What is the full group profit for the year ended 31st December 2025 that is attributable to non-controlling interest? Full might be subsidiary. We see subsidiary profit we attribute to non-controlling interest and parent. Non-controlling interest. Year end is 31st December and you acquired on 1st July. $35, $16. So on 1st July 2025, Pool company acquired 80% of the equity of SAT company. This means 20% is a non-controlling interest. Okay. At the date of acquisition, goodwill was calculated as 10,000 and the non-controlling interest was measured at fair value. In conducting the fair value exercise on SAT company's net assets at acquisition, Pool company concluded that property, plant and equipment with a remaining life of 10 years had a fair value of 3,000 in excess of its carrying amount. Mean carrying amount was lesser by 300,000. Depreciation was lesser. This means we need to charge more depreciation because fair value was 300,000. But asset was recorded on carrying value. 300,000 excess fair value. Mean might be fair value was 800,000 while asset was recorded on 500,000. Okay. What's the life? 10 years remaining life. If we see, if we can calculate excess depreciation. So 300,000 divided by 10 years life is equal to 30,000 for the complete year. When you acquired 1st of July, that is what accounting entry we recorded in previous question for that? Asset credit, consolidated retained earnings debit, and non-controlling interest debit. This means there is part of non-controlling interest. How much? 20%. What is 20%? With 3,000, we need to reduce non-controlling interest or increase. Debiting non-controlling interest mean where non-controlling interest we record in balance sheet equity. This means its nature is what? Credit. So debiting mean is first effect. Okay. At the reporting date 31st December, the goodwill was fully impaired. Okay. What was goodwill? 10,000. So goodwill impairment is 10,000. How much should be deducted from non-controlling interest? 20% of it. 2,000, this should also be deducted. For the year ended 31st December 2025, SAT company reported a profit for the year 200,000. Who is a SAT subsidiary? So subsidiary profit for the year is 200,000. Out of this profit, some will take parent company, some will take non-controlling interest. Is for the complete year. We acquired during the year. This is after date of acquisition. 200,000 is for the year. For the year ended. After acquisition date is 100,000. Post acqui is 100,000. From this 100,000, we need to charge 20% to non-controlling interest. They will take 20,000 positive. So is that non-controlling interest fair value plus subsidiary profit share less impairment less any excess depreciation required. 264. Which three of the following statements are true? In respect of the non-controlling interest be included in consolidated statement of financial position of Zebra Group. Zebra company acquired 75% of the 2 million issued $1 ordinary shares of Penguin Company on 1st January 20x2. Year end is 31st December 20x3. They acquired 2 years ago for 3.7 million. When subsidiary retained earning were 1.77 million. Zebra company has no other subsidiaries. Zebra company elected to measure non-controlling interest in P company at the fair value of 1.140 at the acquisition date. Mean fair value of non-controlling interest is given An impairment review performed on 31st December indicated that goodwill on the acquisition of P company had been impaired by 100,000. No impairment was recognized in the year ended 31st December 20X2. So out of this 100,000, 25% should be deducted from non-controlling interest. Is that? Which three of the following statements are true in respect of the non-controlling interest to be included in consolidated statement of financial position of the Zebra Group for the year ended? Non-controlling interest would be higher if the proportionate method was used. What is proportionate method? Apply non-controlling interest percentage to net assets acquired. What is net assets acquired? What are the net assets acquired? You acquired 75% of $2 million. One mean 2 million is the amount. And non-controlling interest is 2 million is a share capital. And how much is retained earning? That is 1 point. So total is 3.77 million and 25% is what? 90.94 million. What is on fair value? Is that on proportionate method is higher or lower? This is proportionate method NCI. When we calculate goodwill, consideration paid plus non-control earning interest, either we can use fair value, either we can use proportionate method. What is higher, proportionate or fair value? Fair value is higher, so this option is wrong. Is that? The non-controlling interest would be higher if the proportionate method was used. No, it is lower, we have calculated. Using proportional method is 0.942 million, while on fair value basis 1.14 million. It will be included at its fair value on acquisition plus share of post-acquisition earning of a subsidiary. It will be included as a separate component of equity. 25% of impairment in goodwill arising on acquisition will be debited to it. Mean will be reduced from it. Debited mean reduced because it is equity having credit nature. It will be included in non-current liabilities. No, equity. Is that? Yes. 265, please. What was the cash consideration paid by a company for the investment in subsidiary? Not consideration paid, you need to calculate a cash consideration. In out of total, you need to subtract the contingent, then you will arrive at cash consideration. Is there total consideration paid given? Then find that. Consolidation, we perform mainly four calculations. One for net current assets, net assets at acquisition reporting date, one for goodwill, one for non-controlling interest, and one for consolidated reserves. Where we use consideration, goodwill calculation. Put the goodwill formula. So consideration paid, in that we add fair value of NCI and we deduct the fair value of assets acquired. So we arrive at goodwill. So if we can find the consideration paid, we can deduct contingent, we can arrive at cash. Okay. P company acquired 80% of the ordinary share capital of other P company. So Platinum is parent and Palladium is subsidiary. On 1st April 20x0, what is the year end? Might be 31st December. 3 months after the event. By means of cash and contingent consideration at this date, P Platinum mean parent company assessed the fair value of contingent consideration 250. And this is contingent consideration. Platinum company measure non-controlling interest at fair value at the date of acquisition, which was estimated to be 100,000. And the goodwill arising on acquisition was 300,000. This figure is given. This figure is given. If we are having fair value of net assets required, we can calculate total consideration, and by deducting contingent, we can arrive at cash. The following figures for P company are relevant. Ordinary shares of $1 each at acquisition mean share capital is given of 500 at the date of acquisition, and at reporting date it remains same, we know. Retained earning / loss on 1st January 20x0 at start of the year, before 3 months of acquisition, it was 300 negative. But we need retained earning at the time of acquisition. We need retained earning at the time of acquisition. Profit for the year ended 31st December 20x0 is 120. During the year, they generated profit of 120. This means at 20x0 mean 1st January, it was a 300 loss. If they generated a profit for the whole year 120, how much they generated after acquisition? 90. This means 30 profit they generated when? Before acquisition. This means 300 negative. If we adjust that 30, we can find retained earning at the time of acquisition. 120 for the whole year is profit for 12 months. For 9 months post acti is what? 90. Mean 10 per month. So first 3 months is what? 30. In how this 30 is calculated? 120 into 3 by 12. So this means if we adjust that 30 with the opening, mean 3 months profit, this means at the time of acquisition, this was 270 negative. At reporting date, by adding 90, it will be 190 negative or 180 negative. But we need at the time of acquisition. What is the fair value of net assets acquired? How we can find consideration paid? How much is that? From this, add this and deduct this. Because we are going back, whatever is added, we need to deduct, whatever is deducted, we need to add. 430,000. Even you can perform check. 430 plus 100, 530 minus 230 is equal to 300,000. So this is total. Out of this total, how much is contingent? So 430 minus 250, how much is? 180?
Yeah, 180.
Is that? Last question. Indicate by selecting the relevant boxes in the table whether the following statements are true or false. Where a parent company is satisfied that there has been a gain on bargain purchase, mean negative goodwill, it should be recognized in the consolidated statement of profit or loss immediately. Yes, profit and loss mean retained earnings. If the liability of the acquired entity are overstated, then goodwill will also be overstated. How we calculate goodwill? Consideration paid less fair value of assets. Suppose consideration paid is 200, fair value of net assets acquired is 100, goodwill we calculated 100. This fair value we calculated how total assets minus current liabilities. This fair value we calculated how total assets minus current liabilities. Suppose total assets was 500 and current liabilities was 400. So we calculated this fair value 100. If we increase liability, mean total assets will remain same. If the liabilities of the acquired entities are overstated, mean instead of 400 liabilities were 300. This means this 200. If we charge 200 here, what is goodwill? Nothing. If liabilities are overstated, goodwill will also be overstated. See you on Sunday. What time? Good time.
Okay, sir.
We can make 5 to 8 on Sunday.
Actually.
5 Sunday is Sunday.
Yeah, but I might go out now.
Oh, no, you cannot.
That's very
Oh, no, I'll kill you. First week of June, you are having two big paper. These are not piece of cake, especially audit.
not.
No. I cannot allow you.
Okay.
I cannot allow you. After exam, everything will be there. So on Sunday, we are having class